Dear clients, welcome to PhillipCapital's weekly market watch. My name is Derrick, investment analyst from Phillip Securities Research. Today, I would like to take you through a review of the results season for the transportation sector and provide some updates on them. There are four broad subcategories within our coverage, and they are land transport, airlines, shipping, and aviation services. Let me start off with a review of the land transport sector. SMRT reported a marginal decline in its third quarter profits, with an expected increase in the level of capital expenditure associated with the upgrading of its rail network. SMRT also cut its interim dividend to 1.5 cents for this year. ComfortDelGro's performance beat our expectations, largely due to better than expected performance from its taxi business. Between the two companies, we continue to prefer ComfortDelGro over SMRT due to cheaper valuations, lower exposure to the negative near-term outlook for the fare-based business in Singapore, and better geographical diversification of its business. Next, I would like to talk about the performance of the airlines. Singapore Airlines reported a 54% decline in profits for the quarter, but was largely in line with our expectations. We are encouraged by the fact that despite the ongoing promotional activities, passenger yields remain stable on a sequential basis. SIA Cargo's performance was poor, and management had responded by announcing their intention to ground one of its 13 freighters. In a more recent development, SIA announced the sale of its underperforming joint venture Virgin Atlantic to Delta Airlines. We view this positively and expect part of the proceeds to be returned to shareholders in the form of a special dividend. Tiger Airways reported losses of 18 million in the quarter and announced intentions to divest part of its interest in the underperforming subsidiary in Australia. We reiterate our preference for the stock of SIA over Tiger Airways, primarily due to rich valuations on the latter. During the recent results season, we also upgraded our recommendation on NOL to accumulate for three reasons. Firstly, the latest results suggest that efforts to streamline the business have paid off and average operating costs for the liner business have declined. With the planned delivery of newer and larger vessels, we expect unit slot costs to decline further in the next few years. Secondly, the divestment of NOL building releases cash at a time when capex needs are high, and therefore the proceeds from the sale of its building would ease the financial leverage on the group's balance sheet, which is a key source of concern for investors. Thirdly, the competitive landscape and resolute to return to profits is likely to prevent a collapse of freight rates to levels observed in 2011. To conclude our presentation today, we would like to reiterate our positive views on SIA Engineering, SATS, and ST Engineering. We expect SIA Engineering to benefit from the record orders by the SIA Group and believe that the MRO service provider has valuable business units that is underappreciated by the market. We believe that SATS could increase their core dividend payout over the next few years as they seek to optimize their capital structure. The stock of industrials conglomerate ST Engineering could also trade higher, as they are still in the running for a multi-billion-dollar defense contract for the US government. These three companies have an excellent track record of dividend distributions, which we expect to be highly valued by investors in the current low interest rate environment. That is all that we have for you today. Do stay tuned to next week's video. Thank you.